Hey there, everybody. This is Greg Gossett, and today is Sunday, August 28th, 2022. It has been 2 weeks since I've done my last podcast. I think the last podcast I did was on August 7th, 2022. Then I did, before I left, just got out of my positions, thankfully, and then I took a week off. I went on vacation to Cancun. It was really nice. It was really great. First time I'd ever been there. Enjoyed the warm weather. Then came back, did trade last week. And so what we're going to do today is we are going to go back and we're going to take a look at the positions that I exited a couple weeks ago. There's been a week lag here. And then also we'll take a look at the one trade that I took last week as well. But I hope you're doing well. It's been a crazy market. This is the weekend edition of the Gossett Trading and Mentoring weekend review, and so it's good to be back. And I hope you've been staying safe in this market. My gosh, my good friend Stephen Burns mentioned something about this market. He goes, it's unstable. And I think that's the perfect way to sum it up. It does seem very unstable. Of course, we had a huge down day on Friday after the Fed Reserve Chairman Jay Powell mentioned that we're going to have some pain, and right on cue, the market believed and went down. So format for today. First of all, we're going to look at the positions that I exited 2 weeks ago. We're going to take a look at the position that I did take last week and talk about when I bought them, why I bought them or shorted them in this case, and how I'm going to manage them going forward. After that, we are going to talk a little bit about trader psychology. Very important. The most important part of trading by far. I've traded almost 28 years now. And the psychological portion of trading that's what it is. And so I found a good little saying to discuss today. We're going to go over that. And then, as always, I like to do a poem from my trading poet friend Frank, and we'll take a look at that. I think they're always fun and pertinent to what's going on. And then after that, I have gone down through my watch list. I have identified some potential trades that I would be interested in coming this week, depending if they get to the certain levels that I need and that I want. All right. And so hopefully that will be helpful for you. It's always actually helpful for me to prepare for this podcast, because I go through things so carefully. And so anyway, I hope it's helping you out as well. But before we do anything, I've got to start and run the U.S. legal disclaimer. So hang tight. I'll be back in about 40 seconds. Thanks. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Please carefully read and/or listen to the U.S. government required disclaimer before watching this video or live stream broadcast. The video link and disclaimer text are located in the description section of this video or live broadcast, here and here. All right, well, let's get to it. Okay, again, these first 1, 2, 3, 4 positions I got out of about 2 weeks ago, right before I left on vacation. And let's start with Rio Tinto, REO. I did buy REO all the way down here at the bottom, had a nice under 30, over 30 entry trigger, plus a bullish engulfing bar. Entered here. It's going to be a little different because of the dividends, but at 53.04, placed my emergency stop 2 ATRs below my entry, placed my trailing stop level 1.5 ATRs above. It did get to my trailing stop level, which puts me in a trailing stop mode. which means if I have a close below the previous day's low, I will get out of half of the position. That happened here on the 2nd of August with the close below the previous day's low, did take half of the position off. As you know, I always take a portion, 10% of whatever the remaining position that I have off if it moves 0.45 ATRs. Here's the 0.45 up here. 0.67 today, but it's different back here when I bought. But that is how I like to scale. I like to play offense and defense. Defense is an end of day stop, is an emergency stop, offense and trailing stop protocols as well. But the offensive part is just taking 10% of the position off if it ever moves 0.45 ATRs. If it moves 0.9 ATRs, then I take 2, right? So again, bought here, dividend adjusted at 54.03 with the under 30, over 30 bullish engulfing bar. Moved up nicely right away, got to trailing stop level, which was 1.5 ATRs above, into trailing stop mode, have a close below the previous day's low here, got out, and then had another nice big move up. And I was fortunate enough, I made a good decision just to go ahead, take my positions off before I went on vacation. I just didn't want to mess with them. Got out of the remaining position, the remaining half, and the remaining that I had here, dividend adjusted at 60.20. Next day it went down. I thought, oh, that was a good move. And then it went racing right back up. And I saw it on vacation. I was like, oh, it's going higher. But it's kind of, stayed around. It's actually lower here than where I bought it. But the second portion of the position was an 11.83% gain, which I'm very glad for. IWM, okay, this was a short position that did not work out. Let's see, here we go. I shorted IWM here because we ran into an order block. That's an ICT term. This was the order block over here before a move down and structure break. I did short it here at 193.30. Next day came down nicely, did take some profits, but my end of day stop was a close above that order block that I just showed you here at 194.63. Next day moved up and simply just took my stop here. This was a loss of 1.23%, so not so bad. NVIDIA, this was fortunate. I did buy NVIDIA back here on the 9th of August. We took out this previous high, continuation high, came back down into a value gap between here and here. That's where I bought, fortunately, 170.79. You can see my end of day stop would have been a close below the swing low. My emergency stop, 2 ATRs below my entry. Never got there, moved right on up. Thankfully, it moved up here, did scale out some profits. Next day scaled out some profits. Next day scaled out some profits. And again, this is the day that I left on my vacation. So it did get to trailing stop mode, but I took everything off here at 186.97 for a 8.67% loss. Now, had I not taken that off because of vacation, then once it got to trailing stop level, then this would have been the first close below the previous day's low. And it also, I believe, got to 65 RSI. So this is where I would have gotten out. But luckily, this was a 8.67% gain. Sometimes better to be lucky than good because it did go up a little higher the next day. But then, of course, you can see we just came crashing down. Had I stayed in the position, actually, this would have been the stop for that because it closed below the previous day, the previous swings low here. DD, okay, so these are daily time frames. As you know, I like to take trades on both daily, weekly, monthly. So the last three that I showed you were daily. Here on the weekly, this was double leverage DDM or double leverage Dow. I did buy this with a simple intraday or intra-week rejection of the 200-day moving average. Bought it here at 58.28, and this just went skyrocketing up all the way up. And again, I was just fortunate enough that I went on vacation and took this off at near the high. Well, it did go higher the next week here at 67.60. So this was a 14.12% gain, which very, very grateful for. And then the only current open position that I've put on since I've been back has been a short on Tesla. I had this lower high. See, this high is lower than this high. I had this lower high intraday rejection of the 200-day moving average. Bought this at shorted this at 297.03. My end of day stop would have been simply a close back above the 200, but you can see the next day it did go above and then close below, tempted to go above and then close below. My emergency stop up here, 2 ATRs above, end of day stop again, just to close above the 200-day moving average. Did move down, of course, significantly on Friday and did take some profits off as well. This particular position from entry to exit up 3.03%. So all in all, really not too bad of positions. Unfortunately, I went on vacation. I got COVID in Mexico. So I came back last week. I didn't do a lot of swing trading just because, man, I've had COVID a few times and this one was the worst. I got to tell you, the fevers and the body aches and all the other stuff associated with that is no fun. It is no bueno. It is not even close to any type of hot tamale. And I am feeling better. Thankfully, I wasn't sure I was even going to do the podcast this morning when I woke up. But anyway, I rallied at the end of the day. And so anyway, let's take a look at some trader psychology here. This is from one of my favorite channels, the Divergent Trader, at Trader Divergence over on Twitter. Do yourself a favor, subscribe to this channel. It's free, just a click of a button, and he puts out such good information. But this is the 10-20-70 rule. 10% of your efforts should be in identifying a trade. It's really not that hard to identify the trades. You have lots of signals, under 200, over 200, under 30, over 30, convergences, combinations of signals where you have multiple signals, which is really the best way because it means there's multiple groups of buyers coming in. But in the big picture, 10% of your bandwidth really should be just identifying the trade. 20% is managing the trade after you enter. That's a little more difficult. For me, it involves trailing stop levels, taking partial profits, taking partial trailing stop levels off. So there's a little bit more there as far as your bandwidth and the mental energy that you have to put into the trade. But really, the 70% is managing yourself and your emotions. This is what it's all about. I've had challenges with this in the past and the present. Honestly, it's the toughest part. It really is the toughest part. And if I could give you some good advice, learning your entries, not that difficult. Learning how to manage your trade once you have your system down, once you have a protocol down, not that difficult. But the tough part is second guessing yourself. Did you do something right? Do you have an opinion about the market? My best advice to everyone is just create your process, follow your process, position size correctly based upon volatility, and the market's going to do what it's going to do. Sometimes it goes up way higher than we think. Sometimes it goes way down lower than we think, and you just don't know, and you're not going to know. Unless you have some super crystal ball that I'm not aware of. And if you do, please let me know. But it's about risk to reward, everyone. It's literally picking a line in the sand, creating your position sizing correctly, entering, knowing where your emergency stop is, knowing where your end of day stop is, and knowing your process. And then the market's going to do what it's going to do, right? You can't fight it. Doesn't matter if you yell, scream, yell like I do often, be honest. But it all comes down to risk to rewards. There are sometimes you're going to get outsized gains just by holding on and, sticking with your process. And that's what we all are looking for. And that's what you need. That's what you need, because if you're trading correctly, then your losses should be small, but you're going to have a bunch of them, and you need to pay for those with a big gain, because you need to pay for all the little losses and then hopefully have some left over for your profit, right? I mean, that's why we all trade. So the Divergent Trader, at Trader Divergent, 10% is identifying the trade, 20% is managing the trade after you enter, and 70% is managing yourself and your emotions. All right, let's head over to a little trading poem by Frank. My trading poet friend Frank. You can follow him at Frank OD. He posts a poem almost every day. They're always fun. They have some good insight into them, good wisdom. And so follow him over there at Frank OD and read his poems. And I think you'll be glad that you did. Today's poem: a pilot has a checklist before every flight. Gotta make sure conditions are right. Trade with the seatbelt and hold on tight. The market can mock the best laid plans as quick as overnight. All we can do, create our setups, create our process, create our levels, and the market's going to do what it's going to do. And just like I talked about in trader psychology, you have to follow that. A pilot has a checklist before every flight. Got to make sure conditions are right. Trade with the seatbelt and hold on tight. The market can mock the best laid plans as quick as overnight. I think Friday was a good example of that. I'm not sure any of us saw that coming, and it sure did its thing, and it wreaked a lot of havoc. And yeah, pretty tough, pretty tough. All right, so like I said, I did go down through my watch list, every single stock in my watch list, and I looked for potentials for me for next week that I might be interested in at different levels. If they get there, I don't know if they're going to get there. Usually I need a stock to move up higher for some kind of signal, or I need a move down lower to a different level in order to get interested in. But let me start off. Probably my favorite one here is Apple. You know, we had this tremendous run in Apple on the way up here. Not really sure why it happened. It was very surprising to me. But nonetheless, we did get above 70 RSI and then lose it. And that was it. It did come down after that. We came into the value zone. We consolidated for a couple days. We had a big move up on Thursday. But notice the volume. Notice the volume on these, not Friday, but Thursday, Wednesday, and Tuesday. Super low volume, lowest volume I've seen in a long time, maybe all the way back here to like July 25th. But we've made a significant lower high. V1 bullish engulfing bar. We lost the value zone here, but the 200-day moving average is something I'm definitely going to be looking at, either for a move down. It looks like futures are down significantly again tonight, Sunday night. You know, if we come down, test the 200-day moving average and close back above it, and it gives me a good risk to reward ratio, that will be something I'll be looking at. If it closes below and then back above, that's also a consideration. If it slices down through the 200 tomorrow, which I don't know if it will, but in this market, anything's possible, I would also be looking for the 250 SMA or the 300 SMA, or if it gets lower, the 30 RSI. So first level to look for some kind of intraday rejection and close back above would be the 200, and or a close under, close over, or an intraday rejection of the 250, or a close under, close over the 250, or an intraday rejection of the 300, or a close under, close over 300, or an intraday rejection or close under, close over of the 30 RSI. Tons of volume came in here on Friday. Like I said, futures are down. So let's see, we're at 163 moving at, okay, so the 200 is 160. I mean, we could open at the 200 tomorrow. So this is probably my favorite one because it's Apple. Adobe has just gotten hammered. So are there any potential levels on Adobe? Well, we're at a 3362 RSI, and under 30, over 30 would also be good. Let's look at the weekly. Weekly, we're coming to the 200-day move, 200-week moving average, and or the -1 ATR channel, coming back into some support. So what I'll be looking for on Adobe would be an under 30, over 30. I'd also have to go over here and look at the weekly and see if it rejected some kind of level on the larger time frame. I like Apple better. I always like buying at the 200-day moving average much more than I like buying at the 30 RSI, but nonetheless, an under 30, over 30 would be a valid signal on Adobe. Anheuser-Busch, well, interesting. And again, this stock has got hammered. We are at a 32.87 RSI right now, and under 30, over 30 would be legitimate. You see the trend line I have here that connects the bottoms of this low, and this low. So far, it's holding that trend line. I don't talk a lot about trend lines, but they are very helpful. You know, my good friend Ava uses them quite a bit in her trading, and you can follow her at Presence Trades over on Twitter, and I would suggest you do. She's an absolute phenomenal trader. You know, I like to have confluence of signals, and the confluence of signal on Anheuser-Busch may be an under 30, over 30, which is legitimate by itself, and either an intraday under 30, over 30, or a close under, close over. But it dovetails nicely with this trend line. If we could violate that trend line and then get back above it, that would be something I would be interested in as well. But the main signal here is an under 30, over 30. Goldman Sachs down as well, but the relative strength of Goldman Sachs on the financials are much better than the rest of the market. You can see we did close below the 200-day moving average. Now, if we close back above on Monday, that would be something that I would be interested in. It really, really would. So that's pretty much what I'm looking for on Goldman Sachs, is either some kind of close back over the 200 and then using that 200 SMA as my end of day stop. McDonald's also got hammered. This one, who knows whether or not we're going to be able to get all the way down here. 200-day moving average is at 250.09. We're at currently 256.95. I think the 200-day moving average always gives a pretty good risk to reward ratio, because it's a level that a lot of traders, a lot of large financial institutions do like to key off of the 200-day moving average. So don't know if it will get down there. It's still significantly above there, but that's something I'll also be watching. Philip Morris has been relatively strong compared to the rest of the market. Yes, it's definitely come down. We closed under the 200-day moving average. But relatively speaking, it's much stronger. We're to 42 RSI, where a lot of stocks are in their 30s. So a close over the 200 might be interesting. We also have the 250 below. We also have the 300 below. So some kind of rejection, either a rejection of the 200, rejection of the 250, or the rejection of the 300, I think would be a good level and a good risk to reward ratio. Twitter. We are currently under the 200-day moving average. This was a significant big down move. We have a big gap from here to here, which very likely could be filled. Not for sure, but if it does fill this gap, it would still have to get above the 200-day moving average as well. Alternatively, if it heads back down, if the market just continues to crater, an under 30, over 30 would also be a legitimate signal, but the more likely one at this point would be a close over the 200-day moving average. Verizon, Verizon doesn't look bad here. This is something I noticed from one of Ava's tweets. We do have a double bottom with the bullish divergence, meaning we have a low here with deep red MACD bars. We did rally into green, and then we've come back down, and we are now lower than this low. But even though we're lower than this low, see how there's no red? That's called a double bottom with a bullish divergence and a missing right shoulder. We're at a 31.76 right now. We're near the negative third ATR channel. 92% of prices do tend to hold and stop going down and or bounce. So an under 30, over 30 on Verizon this week, especially in light that we have a double bottom with the bullish divergence here, would be very, very interesting to me. And Verizon does pay a nice dividend of a 5.9%, which is pretty good. So the signal for me on Verizon would be an under 30, over 30. And then let's see, lastly, real estate. Well, XLRE is real estate. It's home builders. What caught my attention here on this particular setup is the 50-day moving average. I don't generally buy off of the 50 very often, but I like the confluence of the 50 SMA and the negative third ATR channel here. They're right there together. Again, 92% of prices tend to hold, stop going down or bounce. But I said 92%, right? Not 100%, obviously. But I like this little convergence right here of the 50 and the negative third ATR channel. So, if the futures hold down, very likely it will get there, and it doesn't mean it's going to have, it could stop there temporarily and can continue down. But if we get some kind of close under, close back over the 50, or an intraday rejection of the 50, that may offer a good risk to reward ratio. Of course, you're still going to have to position size correctly. My end of day stop would be a close below the 50, but of course my emergency stop would be much further down. So that's what I've got. I've got Apple with some kind of rejection of the 200, 250, or 300 in the coming week. Adobe, some kind of rejection of the 30 RSI. Anheuser-Busch, some kind of under 30, some kind of rejection of the 30 RSI in light of this trend line. Goldman Sachs, some kind of close over the 200-day moving average. McDonald's, some kind of close intraday rejection or close over of the 200-day moving average. Philip Morris, again, under the 200-day moving average. So this coming week, some kind of close over the 200. And then we also have the 250 right below and the 300 right below. So somewhere in this area is what I'm looking for. Twitter, close back over the 200. Verizon, some kind of rejection of the 30 RSI, and real estate sector, some kind of rejection of the 50. So, in this podcast, I go through pretty quick, try to show you how I manage these. I trade 5 different trading approaches, and there's a lot of rules. There really are. They're not hard to learn, but it takes time. And so I did want to remind everybody that I do teach private one-on-one lessons in the evening time via Skype. I love to teach. I think I'm a good teacher. I've taught people from all over the world, and I teach them step by step the 5 different trading approaches that I use. And we go over position sizing, emergency stops, end of day stops, trailing stop levels, partial profits. It's a really good course. It's a total of 15 hours, and it's one-on-one. It's just you and I on Skype. Each session is 3 hours each, and then I have 5 sessions total. That's where you get the 15 hours. It is $1,750, but I promise you it's worth every single penny. So if you are interested, all you have to do is reach out to me, send me an email. My email is in the link of this description. Just say, "Hi, Greg. I'm potentially interested in taking your course." I'll reply, say, "Hey, thanks for reaching out. And, let's set up a Skype call." Skype call's free. It's not a sales call. I promise I don't do any selling. I just want someone that's motivated to learn how to trade, and I'm very happy to teach them. And then, so in the Skype call, I learn a little bit more about you. You learn a little bit more about me. It's a good time for you to ask me any specific questions about the course. And then after doing with that Skype call, it's up to you in the days and weeks and months ahead. If you decide one day, okay, today's the day I do want to study this course with Greg, then just send me an email and say, "Greg, I'm ready. We'll start." And I promise you'll be happy that you did, and you'll be a better trader. I promise you that. Number 2, if you like online courses, I do have a really good online course called A Deep Dip Buy Stock Trading Strategy. It's on udemy.com. 9.5 hours of video, 26 videos, 15 study guides, and the best part, it only costs between $12 and $15. And I've sold so many of them across the world, gotten so many good reviews and feedback. So if that's of interest to you, the link is in the description of this video. And then lastly, if you like this podcast, if it's been helpful for you, all I ask is that you could hit the thumbs up button. It lets YouTube know that there's some valuable content here, and helps them to promote the channel more, get it out to more people. So anyway, if you could hit a thumbs up button before you leave, I would really appreciate it. But it's good to be back in the States. Mexico was really fun, other than the getting sick part. And man alive, I feel for you that have had this virus, because it's pretty brutal. I've had it several times, but this one definitely was the worst. So anyway, the markets are pretty crazy right now, especially after the Fed meeting. Please be safe. Please follow your rules. If there's anything I can help you with, just reach out to me or leave a comment here. And last thing I'd like to leave you with is, if you could please try to go out and do 2 things today. Do one nice thing for another human being. Do one nice thing for an animal, one act of kindness for a human, one act of kindness for an animal. It really would make the world a better place. And that's all I ask. Because I want the world to be as good as a place as it could possibly be. And I want you to be as good as a trader as you can possibly be as well. So anyway, I hope you have a good upcoming week. And next week, God willing, I'll be showing the trades that I took and how they managed and all that kind of stuff. All right. So on the way out here, I have to run the U.S. legal disclaimer. Take care of yourself, everybody, and appreciate you being here today. Bye-bye. U.S. government required disclaimer. Stock, options, futures, and forex trading is not appropriate for everyone. While there is a potential for large rewards, there is also a substantial risk of loss associated with trading. The material in this video or live broadcast is not geared towards any particular individual or to any particular financial situation and is not intended to meet the particular investment objectives of any viewer. This video or live broadcast, like all instructional materials produced by Gossett Trading and Mentoring LLC, is created and published for informational and educational purposes only. Any and all information contained in, implied, or referenced by this video or live broadcast is not to be construed as investment advice, and no representation is made that any individual or entity involved in production of this video or live broadcast is an investment or financial advisor or is registered or authorized to give any financial advice. We are publishers and educators only. Therefore, the various producers of this video or live broadcast will not accept liability for any loss or damage of any kind which may arise either directly or indirectly out of the use of any of this material, including any loss of profit. No representation is made that any account or investment will or is likely to achieve the profit or losses demonstrated. We recommend consultation with a licensed and qualified professional before making any investment decision. This video or live broadcast is not to be construed as an offer to buy or sell any security, financial instrument, or financial product of any kind. Notice is hereby given that any individual or entity involved in production of this video or live broadcast or their clients may have an interest in any security, financial instrument, or financial product mentioned or referenced. Any simulated or hypothetical performance result depicted does not represent actual trading and therefore may under or overcompensate for the impact of various market factors such as lack of liquidity. Thank you.